Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, a no-commission fiduciary financial planning firm just for optometrists nationwide. And on today's episode, I'm going to talk to you all about what actions we should be taking in a declining stock market. And this is going to be a solo episode, the first solo episode in quite a while, actually. And this is a topic I've wanted to touch on earlier in the year because we have had a bit of a rocky start to the year so far. Maybe that's putting it a little bit lightly, but I wanted to talk to you about how should we think about declining stock markets and bear markets, as everyone's talking about. And what actions should we be taking? What actions am I taking with my own investments? And as I talk with clients, what actions should we be taking during these declines? And so as you probably have heard, if you are invested in any way in the stock market, or if you are following the finance world in any way at all, you probably have heard that we are in a bear market in the stock market. So what does that mean? Well, a bear market basically just means that stocks, broadly, the market has declined from top to bottom, meaning from its peak, and the decline to the bottom has been at least 20% or more. Now, why is that important? Why do we need to label it a bear market and freak out about a bear market? Is negative 18% any less nerve-wracking than 20%? I don't know. It's a bit arbitrary, and I think we just have to throw labels on and name just about everything. So here we are, we're in a bear market. As of today, as of recording, July 18th, 2022, the S&P 500, which is just the largest 500 companies in the United States, that list of stocks, that index was down about 20%, just about 20%, like 19.7. So we're hovering at about that point. And how should we think about that? Like, what does that really mean to us as investors, as optometrists growing wealth towards all types of different financial goals? How should we think about that? The first thing I want to say is that it's okay to be nervous about this. It's human nature to feel nervous when you see your investments declining in value or you see your wealth dropping in value. It's human nature to feel that way, to be nervous about that, to be concerned. That's perfectly fine. What's important, though, are the decisions that you make when these things happen. Those decisions and how you handle it are going to determine, in a lot of ways, how it impacts your wealth building long term. And so I want to start today by talking about how we should think about bear markets, and I'm going to put these events into context. And so there's going to be a bit of data here, so hopefully this data comes off okay in a podcast form. But I want to talk about the history and context around bear markets. So first of all, what should we think about them? Are they something we should try to avoid? Are they something we should be freaking out about? Well, the first part of that is really they are a common and expected part of investing in the stock market. They are an expected and common part of investing. Anytime you invest, especially in businesses, which is what the stock market is, it's a market of shares of businesses, there's going to be risk. There's going to be uncertainty, and the value is going to fluctuate, right? So we can look back historically and see that, okay, this is a common and expected part of investing. And bear markets, meaning that decline from top to bottom of at least 20%, happens roughly every 4 years on average. Depending on which article you're reading or which index or list of stocks it's following and how far back you go, it's going to be somewhere around, on average, every 4 years. For example, if we look back at the S&P 500, which again is it's an index, a list of the largest 500 stocks, businesses in the United States only. If you go back from 2020 back to 1926, the S&P 500 experienced 17 bear markets, and the fall was somewhere between negative 21%, and an incredible negative 80%, which I'm assuming is the Great Depression. So that you have a sort of a range of outcomes, but how long do they usually last? That's a question you often hear. Okay, we have them every roughly 4 years. Okay, but how long should we expect them to last? And we have some pretty good data on that. So Ben Carlson, who writes with his excellent, just awesome blog, A Wealth of Common Sense, he put some data to this, looking at, I believe, the S&P 500. And so he looked at every bear market since World War II, and he looked at the number of months it took to go from the top to the very bottom, and how many months it took after that point to break even, to get back to where that top was, to get back to where you started. And what he saw was that the average decline in those bear markets from 2020 all the way back to World War II, the average decline was about negative 32.7%. Now, there's quite a range of declines there. So you had from negative 20% to negative 56%, right? So there's a range. But what he saw was that the average amount of months it took to go from the top all the way down to the bottom was about 12 months, right? So it took about a year on average to get from the top to the end of it, to the bottom. And then once you got to that bottom, it took, on average, about 21 months to recover back to where you started, back to that top, right? So if you're looking from the beginning, very beginning of the top, down to the bottom was 12 months, and then another 21 months just to break even again. So on average, 2 to 3 years, right? 2 to 3 years to experience that. And remember, that's average. So there's a range. If we go back to March and February of 2020, back to COVID times, right in the thick of it, we saw a substantial 33.9% drop, all in 1 month. It took 1 month to go from top to bottom, 33%. And then it took 6 months to recover, right? So that was a lot happening in a super short period of time. On the other hand, you look back at early 2000s, when all these tech companies were going bust. It took 31 months, almost 3 years, to go from top to bottom, and that decline was 49%. And then it took another 48 months, which is just incredible, 48 months back to recovery. So that was with large U.S. stocks specifically, that was a substantial difficult period to go through, just in large U.S. stocks. So that's about average. So top to bottom, on average, about 12 months. Bottom to top, again, the break even is about 21 months. So that's the expectation in terms of what you can expect in terms of time. Now, of course, that was in the past. We don't know exactly what the future will hold. We don't know exactly what this year will hold. So nothing is guaranteed or certain for this time, but the past gives us a good base for expectations on what to expect. So what do we learn from this data? What do we learn from this history? Well, number one, we can see that these capital markets, these investment markets, have rewarded long-term, disciplined, patient investors. For those who are able to stay invested and stick with it, they've been able to enjoy positive returns over really long periods of time. So that's number one. But number two, we learned that in order to get those long-term average annual returns, you have to put up with some nonsense. You've got to deal with some risk in the short term. That short-term risk, the declines, that short-term risk is sort of the ticket for entry to get on board and to enjoy those really long-term returns. So yes, you've got to deal with some declines with some regularity. That's an expected part of investing. That's a feature, not a bug. Number three, we see that bear markets do tend to happen with some regularity. That's declines of 20% or more. And number four, and maybe most importantly, we see that these declines are temporary. They're temporary. Now, how long it takes for that recovery is different for each one. We don't know exactly how long this one will last, but we've seen that those declines are temporary. And so for those who are able to stick with it, stay invested, have been able to see that recovery through. And now I want to talk about what actions can we take, because In my opinion, selling and buying, trying to time these markets is not an action that you should take. And there's data around what happens to a portfolio when you miss out on the best day and the best week and the best month and the best 6 months. When you miss out on even these short time periods, it really impacts your long-term returns. And so rather than trying to time these markets, because you have to decide when to sell, and then you also have to decide when to get back in, and you have to be right both times. So rather than trying to time these markets, if you are a long-term investor, the prudent approach, in my opinion, is to stay invested, stick with your investment plan, and keep your eye on those long-term goals. But there are actions that you can take, right? What are some things I'm thinking about as an advisor, looking over my clients' portfolios and my own? What actions can I take? First thing I want to say is that, of course, none of this is investment advice for you. Please don't take investment advice from some guy on a podcast and then apply it to your portfolio. Do your own due diligence, talk to your own advisors, and make decisions that are right for you. But hopefully these are some things that are food for thought. So what actions can we take? Number one, revisit your time horizon, or remind yourself of your time horizon. And what I mean by that is I like to separate out dollars, buckets of dollars, based on when you're planning to use that money. For example, if we have an emergency fund, that's a bucket of dollars that's super short term. You absolutely do not want to invest those dollars. Those are things you want to be there when you need them. So you're looking at cash or something similar, right? On the other hand, if you were talking about goals that are 10 years plus, think about long-term financial independence, long-term financial freedom, retirement. That's a goal that, when you think about it, is, for many of us, several decades away, right? 10, 20, 30 years maybe away. And even when we get to that point where we are work optional, where we're financially independent, I would doubt in any scenario we're going to be selling all of our investments and holding cash. Instead, what will happen is that over time, you're going to sell some of it to create cash, and you're going to withdraw that cash and use for spending. But the rest of it, maybe the majority of it, is going to stay invested for the next 5 years and the next 5 years and the next 5 years, right? So the time horizon for that money is really over the rest of our lifetime, several decades. So remind yourself of what is the goal, what is the time horizon for the money you're investing. If you are a long-term investor, 10 years out, and there's other goals too. There's saving for kids' college expenses, maybe 10 to 18 years away. There's saving for a house down payment 10 years from now for a dream home, a business, whatever it is. There are other goals too. So if you are a long-term investor looking 10 years plus, multiple decades, think about what a bear market today means for you. A decline in the stock market means for you. Number one, you have plenty of time to allow your investments to recover. Right? We talked about expectations around how long it takes. We can look back historically and get an expectation of how long we may have to wait, although we don't know exactly. But you have that time to allow your funds to recover. So that's number one. Number two, you're not relying on those funds right now. You're still working. You're still producing an income. You have, the fancy term is human capital. You have an ability. You have an asset, your ability to work. So you're not relying on these investments right now. And number three is that the longer you can stay invested, the higher probability that you're going to have positive returns, right? So the length of time you're going to be invested is really important. And we can see this. This is a chart I put together in a blog post I did a little while back called Your Guide to Thinking Through Stock Market Declines and World Events. I'll put that in the show notes. But something I'd looked at is if you look back at the U.S. stock market. So this is based on the Russell 3000. So the whole U.S. stock market. If you look back to 1979, I looked at 1 month periods historically. So all the 1 month periods in that time, all the 1 year periods in that time, 5 years, 10 years, 20 years, and 30 years. And I wanted to see what percentage of those time periods had positive returns and negative returns. And in the short term, there's a lot of uncertainty. If you look at 1 month, there's 516 1 month periods in that time period. 65% 65% of them are positive, 35% of them are negative. So there's some uncertainty there. You don't know month to month, even year to year, which are going to be the positive, which are going to be the negative. So there's a lot of uncertainty in the short term, even if you go to 1 year. So for 1 year periods, that's 43 years, 84% are positive, getting better, 16% negative. 5 years is pretty similar, but when you get to 10 years, so 5 years is 90% positive, 10% negative. If you get to 10-year periods, now we're talking decades, 94% of 10-year periods were positive, 6% were negative. And then we get to 20 years. 20 years is where something interesting happens. There were no 20-year periods going back to 1979 where stocks had negative returns. The U.S. stock market had negative returns. And there were no 30-year periods, right? So that the longer your time horizon, the more reliable the probability is that you're going to see positive returns. So it's really important to line up your thinking, your focus with your time horizon. If you have a really long-term time horizon, and we're talking multiple decades, well, look at the expectation that history has given us around what long-term returns look like. History tells us that the probability is very high that you're going to see positive returns. Now, of course, that's not guaranteed. For all my compliance folks out there, that's not guaranteed at all, but at least history gives us an expectation. The odds are in your favor. So try to line up your thinking, your focus on, even though it's hard, I know anytime there's big events, anytime there's dramatic declines or things like that, our attention, our time horizon gets shrunk. Our attention comes to what's right in front of us and what's going on today. But try to keep your focus on that long term, right? You're invested for several decades, potentially over the rest of your lifetime. Focus on that. Next action to take. Next action I'd be looking at is keep buying shares if you are a long-term investor. Just continue to contribute to your retirement accounts, contribute to invest on preferably an automatic schedule. A lot of your success long-term may come from your ability to buy investments and continue to invest during bear markets. And there's some data around this too. So when you look back historically, and this is some data from Dimensional Fund Advisors, and full disclosure, that's a fund family I use quite a bit in my own models within my firm. But when you look back historically, after 10% market declines for the U.S. stock market, 20% market declines, and 30% market declines, you can see what the returns were in aggregate 1 year, 3 years, and 5 years later, right? So let's imagine you are investing during the decline and you're at the bottom. What happens to those returns 1 year, 3 years, and 5 years later? So when we look at 10% declines, a year later, you saw on average, 11% return. 3 years, 32% return on average, right? The whole time period. In 5 years, during that 5-year chunk afterwards, 68% return during the whole period, right? That's cumulative, which is substantial. And we see this after 20% declines, so similar to what we're seeing now. After a 20% decline, on average 1 year later, you saw an 18% return. 3 years later, you saw 35% return over that period. And then 5 years later, you saw on average 71% return over that whole 5-year period. 30 years after a 30-year decline, you saw pretty similar numbers. So what does that tell us? Well, I think something we all sort of know intuitively, that when shares are declining in value, it is assuming we are broadly invested, are diversified, you're able to buy all of these shares that you want to hold for decades at a cheaper price. If we talk about valuations, right, what we see is that the value for these businesses, this broad basket of businesses, has gone down, which means our expected returns for the future, long into the future, have gone up. So you can now buy all these things at a discount and hold them for the next several decades. You know, the odd thing is we see this with all sorts of other stuff in our life. When things go on sale at the store, that's a discount we want to buy. When houses go on sale, the house that we want goes on sale, we want to buy. If a private practice that you believed in and cash flows are strong temporarily goes on sale. Yes, you might wonder what's going on to cause that, but if you feel good about it, you're going to want to buy that practice and those future profits at that discount. So we see that in other parts of our life, but for some reason, it's human nature that when our investments decline, our first thought is to sell. Often, our first thought is to sell, and it should be the opposite. These are buying opportunities if you are a long-term investor. So next one is keep buying shares. Number 3, rebalancing. So what is rebalancing? Rebalancing basically means, think about when you put together a portfolio, which is just your mix of stocks and bonds and the different categories of stocks like U.S. versus international, large stocks versus small stocks. Typically, you're going to allocate a certain percentage of your investment pie to each of those different categories. And a part of why you would do that is to manage risk, right? So that you're broadly diversified, you're hitting all these different categories of investments, you have an appropriate mix of stocks and real estate and bonds based on your risk capacity and your feelings around investing and your goals, your time horizon. What inevitably happens, especially when there's big swings like we might be seeing right now, is that one category or a few categories end up higher than you initially wanted, and other categories end up lower than you initially wanted. For example, if there's a stock market decline, what may happen is you'll see bonds higher than you want in your portfolio and stocks lower than you want in your portfolio. Let's say if it's 60-40, 60% stocks, 40% bonds. Bonds may be 50% of the portfolio and stocks may be 50% of the portfolio, right? So you're a little bit out of balance. You're out of whack. And so rebalancing is simply selling the stuff that's too high, trimming the things that are too high, and using that cash to buy things that are too low. So it brings your investments, your portfolio back into balance, back to that sort of risk profile you agreed to hold when you first picked that allocation. And it also allows you to systematically sell high and buy low, right? If you are trimming bonds when they're too high and buying stocks when they are too low, that's an opportunity to, like we mentioned earlier, buy all those shares at a discount. So rebalancing is something we think about doing. Of course, that's something you don't want to do too often. There's some science to rebalancing when I look at the research, but also quite a bit of art. So it's not something you want to do too often on a regular basis, maybe once a year or twice a year. And then when there's huge swings, but at times when all stock categories are moving together or where we had a decline like earlier this year in bonds too, there may not be obvious opportunities, but look at rebalancing and just trimming what's too high and buying what's too low in your mix. The next thing I think about is tax loss harvesting. So what is that? What that means is that when you have a taxable investment account, right? So this doesn't apply to retirement accounts, IRAs, 401ks. It doesn't apply to retirement accounts. This is only for taxable brokerage accounts, taxable investment accounts, not connected to retirement. So when you invest in those accounts and the investment declines in value more than what you bought it at, if you sell it, you are creating a capital loss, right? So your investment lost value, you sell it, that's a capital loss. And so what tax loss harvesting is selling those things that are at a large enough loss to where it makes sense, and then immediately, as quickly as possible, buying something that's similar enough to that which what you sold, but that's not substantially similar. That's not exactly the same. And all that allows you to do is it allows you to book that loss, that capital loss, on your tax return for tax purposes, right? So I want to emphasize this is not a method of timing the declines in the market. You're not staying in cash and then investing at another point when you think it's recovered. No, this is selling just to book that capital loss and immediately buying something similar but not exactly the same. And why do you do that? Well, when you have capital losses, Capital losses are able to offset, firstly, capital gains, right? So if you sold other investments for a gain, which is higher than you bought it at, if you sold a rental property, if you sold a business or practice, right? If you have other gains from other investments, these losses help offset those. And if there's any losses left over after you've offset any gains, if there's any losses left over at the end of the year, up to $3,000 of those losses can offset all the other income on your tax return. And anything above $3,000, right? So firstly, that's a deduction against your other income. Anything above $3,000 is just carried over into future tax years, right? So you're just creating this tax deduction, this tax benefit. It's a tax planning tool. Now, there's a lot of complication that comes with this, right? So this is something you want to do carefully and or rely on your advisor to do with you. There's something called a wash sale rule where you can't buy the exact same or something substantially similar security 30 days before or 30 days after you do this. So basically, the IRS wants to make sure you're not doing this purely for the tax benefit, which we sort of are. So you can't buy that exact same security, that exact same fund or ETF or whatever you're using, or something exactly similar, substantially similar, 30 days before or 30 days after. So that's something you need to watch for. What we typically do is to buy something that's pretty close to similar, but not exactly the same. So this works really well in mutual funds or ETFs. So if you are buying, let's say, for example, an index fund that's tracking one U.S. stock market index, you may consider buying another one that tracks a different U.S. stock market index, but is pretty close. Maybe the S&P 500 and then the Russell 3000 or something like that. Or the Russell 1000 for large companies. So that's something we typically do. That's sort of common practice. So that's something to look at. Of course, you also want to make sure that the loss is worth it. That there's some real benefit to that from a tax standpoint. If it's just a really small loss and you're doing all this trading, that may not be worth it. And then you also want to think about the fact that you may be out of the market one day. What that means is that you're going to sell, and then it's going to sit in cash, not invested, for a day or maybe more, depending on if you're using mutual funds or ETFs. And of course, the market may go up or it may go down, right? And in times of really heavy volatility, that may actually make this whole thing not worth it. So it's something to be careful about, is just understanding that you may be in cash out of market for a day or so. So that's something that can be done. Again, it can get complicated. It takes some real planning. So that's something I would just strongly suggest talk to your financial advisor about, making sure that's being done where it makes sense. The next thing is Roth conversions. So Roth IRA conversions, what that is that you are, if you have a pre-tax traditional IRA, those are pre-tax dollars in a individual retirement account, you can convert those, which is just transferring those dollars directly to a Roth IRA. And so you're transferring pre-tax dollars and converting it to after-tax dollars in the Roth IRA. Sorry if this is making your head hurt thinking about this, but that conversion, because you're going from pre-tax dollars to the Roth IRA, whatever amount that you convert, that you transfer, is considered taxable income on that year's tax return. But the benefit is that amount sits in the Roth IRA and it grows tax-free, and in retirement, as long as you follow the rules, can be pulled out tax-free. So if it already is going to make sense from a tax standpoint, because this is a tax strategy, this is about taxes, tax planning, if it already makes sense from a tax standpoint, you can do Roth conversions. And one of the reasons this makes sense is because when you do the conversion, you are converting dollars and not necessarily shares. So if the value of the shares decline, you can convert the same amount of dollars, and you're moving over more shares, right? Because you're converting the same amount of dollars, but you're converting more shares. And hopefully that's making sense the way I say that. As I say that, it's probably coming off a little bit confusing, but that's something you can potentially think about if it already is going to make sense from a tax standpoint. Now, usually we don't know if something like that would make sense until the end of the year when we have a good feel for income, especially if you're a practice owner, as profitability and income is fluctuating throughout the year. But that's something to consider. If you're withdrawing from accounts regularly, you want to have a process for portfolio withdrawals when things are going crazy like this. And you want to make sure that you are selling, trimming the things that are higher, and avoid selling stocks if you can when they've declined. So just be careful about where you're trimming from, where you're selling from to withdraw money. And it usually makes sense to have a cash buffer, a small amount, for reasons like this. So just be careful about when you're withdrawing from accounts during big declines like that. Another action we're taking is if we have cash that's lazy cash that's not being used, there's no goal attached to it, you're comfortable investing that for a really long period of time, decade or more, that's cash that you can put to work. It makes sense to do that during a decline as well. And then lastly, one last thing I want to mention is that focus on what's in your control. We don't have control over the markets. It sometimes feels like we should, sometimes we think we do, but the reality is we don't. We don't have control over the day-to-day fluctuations, month to month, year to year, as prices of all these businesses are just adjusting and reacting to news as it comes in. We don't have control over that, but we do have control over a lot of things that are probably more important to the success of your finances long term. Number one, you have control over your optometry career and your practice. Those two things are going to be the biggest reason, the biggest driver of your long-term wealth building in the long term, in you being able to build wealth for yourself, for your family, and for your community. Focus on your career, improving your career, and improving your practice. The amount you invest and how consistently you're investing, contributing to your retirement accounts, investing on hopefully an automatic system. You have control over that. Cost in your investments are a really big one. You have control relatively over the fees within the expense ratios within the funds you're using, or taxes. If you are investing outside of retirement accounts in a taxable investment account, be careful about what those investments are doing to your tax return and how often you're trading within those accounts and how often mutual funds are trading if you're using mutual funds. So watch out for taxes because that can have a big impact on your returns long term. And then lastly, your behavior. So much of your long-term investment performance is going to be determined and impacted by your behavior. The decisions you make, yes, during good times as you're continuing to invest, but especially during big dramatic times like bear markets and declines. Your behavior, the decisions you make during these times are going to be super important. Whether you decide to sell out during a decline or whether you decide to stay invested, to continue to invest, to stay invested for the long term. That's something that's within your control. And then lastly, enjoy life. Focus on the things within your life that are going to bring you joy and positivity, things that you enjoy. Try to tune out as much as you can, which I know it's super hard because you're getting constant updates on your phone every day about this stuff. Try to tune out the noise, focus on what's in your control, and enjoy your life. So those are some of the actions I'm thinking about. Again, all of these opportunities really depend on everyone's individual situation. So as far as what works for you, well, do your own due diligence. None of this is individualized investment advice or tax advice or financial planning advice. Do your own due diligence. Talk with your own professionals. Figure out what makes sense for you. Hopefully, these are some things I'm thinking about with my own money and with my clients in my practice. But hopefully, these are food for thoughts to help you plan within your own investments. And anything you have questions on, feel free to shoot me an email at Evon, EVON, at optometrywealth.com. Everything I mentioned here, all the different resources and links, I'll put in the show notes, which you can find by just scrolling down on whatever app you're using. It'll usually be at the bottom. Or you can go to my website and find the show notes at the Education Hub on my website, optometrywealth.com. And while you're there, if you'd like, you can schedule a no-commitment introductory call just to talk about your investment approach and our investment approach and see if we can be a resource for you for that or really anything else that's on your mind. So I really appreciate you listening. For those who have been listening all along, new listeners, thank you so much for hopping on board. Hopefully this was helpful. If you like the today's episode, share it with your peers, and please leave a review. Any feedback that I can get from you is super helpful to make this a better and better resource for you and for the optometry profession. So with that, I just want to say thank you once again. I will see you on the next episode. And in the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.